Hi, it's Brian Decker with your Market Minute. Have some great news for this year-end rally we call the Santa Claus Rally. Since 1950, how does the S&P track in these last 6 weeks of the year? Well, it's good news. Since 1950, we go from where we are at S&P 4400 to 4800. That's a 9% return for year-end. What causes this? Well, in the last 6 weeks of the year, money managers and mutual funds that are behind the S&P or behind their target return, they pile into the market. It's just a crowd mentality that pushes markets up into year end. And there's a bigger picture on the seasonality also that's important to know. Since 1950, if you put $10,000 in the S&P May 1 and sold November 1, that 6-month period, $10,000 from 1950 to today would produce very little. Maybe 10,000 would become 12,000. It's very little. However, if you put 10,000 in November 1 and sold May 1, that 6-month period produces most of the year's gains. That 10,000 is worth many, many multiples of that 10,000. So we're in the good seasonality from November 1 to May 1, and we're in the Santa Claus Rally. So we expect good markets for the next 6 weeks. And that's great for us. We have the offensive team on the field. We plan to capitalize on that. We've already got our year-to-date gain for the 6% bogey, and we're adding on top of that. So this is Brian Decker. Hope you have a great Thanksgiving and have wonderful family gatherings for the holidays.